The accounting cycle and financial reporting flow. 1. Transaction analysis. Each business event is analyzed and recorded in journal entries. 2. Journal entries and posting to ledger. Double entry bookkeeping ensures debit equals credit. 3. Unadjusted trial balance. Aggregated balances from the general ledger before adjustments. 4. Adjusting entries for accruals, deferrals, depreciation, and estimates to comply with accrual basis. 5. Adjusted trial balance reflects more accurate financial position. 6. Financial statements preparation based on adjusted trial balance. 7. Closing entries. Temporary accounts, revenues, expenses, close to retained earnings. 8. Post-closing trial balance used for the next accounting period. The 4 core GAAP-compliant financial statements. 1. Income statement, statement of earnings, purpose, shows company profitability over a specific period. Key elements: revenues, cost of goods sold, COGS, gross profit, operating expenses, other income/expenses, net income. GAAP rule: use accrual basis, match expenses with related revenues. 2. Balance sheet, statement of financial position, purpose, presents the financial condition at a point in time. Key elements: assets, current and non-current, liabilities, current and long-term, shareholders' equity. GAAP rule: assets recorded at historical cost unless impaired. 3. Statement of cash flows, purpose, tracks inflows and outflows of cash. Categories: operating activities, investing activities, financing activities. GAAP rule: 2 acceptable methods, direct and indirect. Most companies use the indirect method for operating cash flows. 4. Statement of changes in equity, purpose, reconciles beginning and ending equity balances. Includes retained earnings, issued stock, other comprehensive income, OCI, dividends. GAAP rule: all changes in equity, excluding owner contributions/distributions, must be presented transparently. Adjusting and closing entries, GAAP focus. GAAP mandates that financial statements reflect all earned revenues and incurred expenses, even if not yet received or paid. This requires adjustments such as accrued revenues, e.g., services performed but not yet billed. Accrued expenses, e.g., wages incurred but unpaid. Deferred revenues, cash received for services not yet performed. Depreciation, systematic allocation of fixed asset costs. Closing entries ensure that temporary accounts, revenue, expenses, dividends, are transferred to retained earnings, resetting them to zero for the next accounting period. Ethical and regulatory considerations. GAAP compliance is not just about accuracy, it's about integrity. Misrepresenting revenues, e.g., recognizing unearned income, is a fraudulent act. Failing to disclose contingent liabilities violates the full disclosure principle. Overstating assets can lead to investor deception and litigation. Fines, penalties, auditor scrutiny, reputational damage, and even criminal charges may arise from noncompliance. Real-world case example. Case: WorldCom scandal. 2002, WorldCom inflated earnings by recording capital expenses as operating expenses, violating the matching principle and revenue recognition principle. The manipulation added over $3.8 billion in false earnings, leading to bankruptcy and criminal prosecutions. Lesson: small manipulations snowball. Adhering to GAAP protects your company and your career.